strictly speaking, a lack of adequate risk control and management of these banks that caused their demise?
Well, certainly each bank has their own unique story. However, one common theme is that these are commercial banks, and therefore these commercial depositors had deposit levels that are well in excess of the FDIC 250,000 insurance cap. What that means is that the deposits are less sticky, so that if there's a loss of confidence in the bank, that there's a higher propensity for a bank run. That said, for SVB specifically, it does look like there were egregious decisions made in the treasury function around SVB. If you may recall, there were tens of billions of dollars flowing in deposits around Q4 21. That was peak crypto, that was peak venture funding, peak capital markets. They turned around and took those deposits, and then they bought long duration treasuries and mortgage-backed securities. Unfortunately, it was also peak fixed income. And then we entered a year of interest rate increases. And of course, that led to a significant unrealized loss on the hold to maturity book of Silicon Valley Bank. So for SVB specifically, a mix of solvency and liquidity issues. For Silvergate, I think it was a loss of confidence, primarily driven by social media and fear. Silvergate's honored every single depositor withdrawal. And then for Signature, we still need to learn a lot more. No one expected Signature to be seized, not even the hedge funds that were shorting Signature. There's some initial reporting that there may be some deficiencies around audit and control. And certainly all three of them suffered from a run on the bank. You know, these three banks are born of the internet, and they're also failed by the internet, namely by two things: digital wire transfers and social media, the pace and velocity of information.
Right. Ram, I guess the question right now, I think that many are asking is, what is the next shoe to fall?
Well, it's a great question. You know, I think first off, this is not yet systemic. And the bank regulators this past Sunday, as you know, announced an intervention to make unsecured, uninsured depositors whole at these institutions. You know, right now there's pressure on certain regional banks, and you know there was an intervention with First Republic Bank to provide them a credit facility from the Federal Reserve and J.P. Morgan as well. So that's really the area to focus on. And if you take a step back, what's happening is that you've got this tension between the deposit rate required to retain depositors, especially commercial depositors or corporate treasuries, versus the much higher yield that you can obtain in the money market. A Vanguard money market fund generates a 4.5% yield. A bank cannot compete with that. So for example, with Signature, we saw that over the last 12 months, there was a 20 billion decline in deposits, about 20% decline in deposits for Signature Bank before that then turned into a bank run. And that's the broader tension at work, and that's an issue the Federal Reserve has to deal with. If the Fed keeps raising rates, it creates more pressure on the regional banks. On the other hand, if they do not, then they stand the risk of losing their credibility in fighting inflation.